Hello and welcome to our talk today. For today's conversation, I want to focus in on how most merchants are overpaying transaction and processing fees by an average of $2,400 per year. And it may sound like a really large number, but we're going to break down how easily this can happen to just a regular business owner who simply doesn't understand how payments work. Hi, my name is Crystal Little, and I am founder and CEO of Paygent.ai. We are not a processor, but we help business owners understand how payment processing works. Our goal is to help more small business owners take control of their payment processing and thereby reducing their fees by making simple changes that have a huge impact on their bottom line. In today's conversation, we'll go over some simple ways that you can make changes. But before we do that, let's first dive into how this even happened. So let's talk about payments as a whole. It is probably surprising to most people to find out that payments is an unregulated industry. This means that there is little to no governmental oversight, there's little to no regulatory oversight, and that means that processors have the capabilities of truly making decisions for themselves and for their customers. Now, while most processors mean to have the best intentions in mind, the reality is that we are all in business to make money. And if we are all in business to make money, we do things that improve our bottom line. Much like a small business owner may adjust their pricing, payment processing and processors adjust their pricing to meet their own margins. And if you don't understand how that works and how that's being communicated to you, you could very easily start overpaying completely unknowingly. So let's talk a little bit more about that. So the way that payment works is a transaction happens at the point of sale. So this can be anything from a swipe of a credit or debit card into someone keying their information in online, submitting through Apple Pay, any number of ways to transact. And there are many is where the transaction occurs. Now, that is not the only step. In fact, far from it. There are so many layers to the transaction, each one of them being a different potential vendor who touches that transaction. And of course, those vendors need to keep their lights on. Therefore, there's a fee to that service. So starting with the original transaction, that happens with the actual acquirer. And so the acquirer or your payment processor may give you a digital front end or a virtual terminal where you can key in information. They may also give you a device for either your mobile phone or a physical device where you can actually swipe a card. These are called terminal devices. These are different methods for being able to take that transaction. That has a cost. Then when that transaction goes through to get routed for approvals, it goes through a gateway. That gateway has a cost. When the gateway approves or denies a transaction, it then goes on to the card brand to determine what the interchange rate is. That has a cost. Once the card brand determines what the interchange rate should be, then that actually gets passed on in terms, and that's actually justified by different things like reward programs or fees that the end consumer pays to actually hold that credit card. Well, those come at a cost. And if you're not seeing the trend here, the reality is for one transaction to happen, there are many people who touch that transaction, and each one of these bona fide businesses need to be compensated for the amount of effort that they are putting into settling that transaction. Well, because there's so many hands that touch this, it's very, very easy for costs to start to rise. Let's say each one of those different vendors increases their rates by 10%, 5%, whatever nominal amount you want to say. When you do it times 5, it actually becomes a meaningful change to the end business owner. And since business owners at the end of the day are the ones who are truly paying for these fees, it impacts their bottom line. Now, I'm not to say that there isn't a cost to doing business. Of course, we want to accept digital transactions. You want to be able to accept as many different forms of payment, and cash and checks simply aren't the prominent payment methods anymore. And so you need a way to be able to take that charge. But you need to be able to also protect your own margin. And so the cost of doing business, which is what we sometimes hear as payment fees, is actually something that's within your control. but it's basically needing to understand how that transaction happens and how many different touch points occur over that transaction's life cycle. If you can't see the layers, you cannot manage the cost. So understanding this is fundamental 101, which is why we want to spend so much time at the beginning of this conversation to truly explain this in a way that makes sense. So what do you do about this? How do you monitor it? What can I do? Well, owners focus on customers, payroll, revenue. What we tend to see is most business owners fail to focus on payments. Or if they do focus on payments, it's a set it and forget it. And they begin their payment journey at the beginning of their company's history. And once they're able to accept payments, then we're good to go. And the reality is even though you did set it, you should not forget it because things do change. And much like your own business, and you have to take a look at your own business to figure out, is it still healthy? Are we charging the right rates? Are we really using this in the right way? And do we have the right people? Do we have the right structure? All of those questions that you're asking to run your business day to day are the same fundamental questions that you should be asking about your payment stack. So let's talk a little bit about this some more. On average, 2 to 3% doesn't sound like a lot, except for that is your margin. And this becomes how you are able to fulfill your own debt obligations, how you're able to grow your company profitably, how you're able to pay for your employees. All of those things add up. And at a 2 to 3% processing fee rate, it can add up very quickly. Now, important to note is I mentioned it's a 2 or 3% rate because that is what you get quoted when you sign up for payments. There is a term within payments that we use to normalize how much payments actually cost, and it's called an effective rate. An effective rate, simply put, is the total amount of fees over the total amount of process volume. You literally divide those two numbers and you end up with a percent. Your percentage rate determines what your overall effective rate is. Why this is important is oftentimes you are quoted a rate at the beginning. Let's say it's a flat rate, 2.9% flat rate. That sounds wonderful and sounds completely within norms, except for they didn't tell you that there was going to be a statement fee added to this. And we may not have told you that there is a settlement fee. And don't forget to get PCI compliant, because if you don't, that's another fee too. And so that 2.9% all of a sudden becomes 3, 4, 5% without you even realizing it. And if you didn't know better, you thought you were still getting a good deal. So calculating your effective rate is super, super important to maintain oversight on your actual health of your payment processing. So there's some other ways that you need to be cognizant of overpaying. And in particular, there's 3 particular areas that I want to touch on. The first one is with flat rate processing. And flat rate processing means you are charged that flat rate, like the 2.9% that I mentioned. However, there's a reason it's set at that rate. It's set at that rate so that the payment processor can cover all of the transactions that fall below that rate. So for instance, if you are a convenience store who happens to have a lot of in-person payments or debit card payments, even better, then if you are being charged 2.9%, then I am here to tell you you are severely overcharged in fees. The lowest rate of fee is on a PIN debit card. Why is it? Couple of reasons. They need to swipe. They have to key in their PIN number, which means 2 things. They were there physically, you saw the person, and they had to have a secret code to access their money. That at times can be as low as 0.25%. That's a pretty regular number for PIN debit transactions. If you happen to be with a flat rate processor, let's take Stripe as an example or Square as an example. If you are with a flat rate processor, then even though your fee should have only been 0.25, you're being charged 2.9% flat rate on that transaction. And that's important for those companies to have because you offset the transactions that are more than 2.9%. So thank you for your service to all the other businesses that you subsidized. That's not why we're here, right? So understanding the type of transactions that you take is really important, and flat rate should truly be reserved for organizations that take payments that are card not present, meaning the person is physically not there. Online is a great example, over the phone, another great example. Those are the highest fees. And if you are in the highest fee bucket, then something like a flat rate transaction actually makes a lot of sense for you. The other one is, and I kind of hinted on this already, which are small line item fees. These are amounts that are added to your statement that may not be disclosed at the beginning because they're circumstantial. Things like monthly access fees. As surprising as that is, there are a lot of platforms and a lot of processors out there who will offer you a front end and offer you the ability to take payments online, but you're paying for that. And it's addition to the rate that they quoted you. Other examples are PCI, which I'll go into PCI and PCI compliance in another video. But if you are not PCI compliant, then there is a mandatory fee that gets applied to you. And even worse, the processors have the ability to mark that fee up. So PCI compliance fees are not made equally, or not created equally and treated equally, rather, across payment processors. Really, really important to know. Other things you may see is a gateway fee, which I touched on earlier, and that's all about paying that vendor to be able to settle that transaction. You have certain service fees or miscellaneous fees, or you may have an analytics fee. The reality is that each processor can call it whatever they want. And much like our beloved pharmaceutical companies, sometimes the name of these fees is really creative and made to make you feel like you're not being paid for something you didn't want. The reality is, if you don't know what that fee is, the good chance is you probably shouldn't be paying it. The other ones of the third that I mentioned is with different types of real world mixed transaction use. Okay. And sometimes we call this different tiered pricing. And so tiered pricing, as my great example, is American Express is the highest fee credit card out there. And it's because they have the most generous rewards program. There is no such thing as free lunch. And a generous rewards program is typically being subsidized by the end business owner. That's why some organizations don't even allow for you to use Amex at their facilities. But for those who do, you may get set up on tiered pricing. And they do this, again, to offset fees for people who are on lower rates. Everybody needs to make money, and everybody wants to be profitable. This is how processors do this. So on a tiered pricing structure, you will have some of your transactions may come in at a flat rate of 3.5%. So let's say it's all your Amex and they come in at 3.5%. Well, they're setting that rate not because we think that rate is, they're setting that rate because they need to hedge their own fees. And so the expectation is that the fees coming in for those types of transactions should be below that quoted rate. If it's not, then they're losing money, and they're not in the business to lose money. However, they may then offer and make a very enticing pitch to you that if you do debit, it's only 1%. So if you do Amex, it's 3.5, but if you do debit, it's 1%. Sounds like a smoking deal. And if you're an organization who does a lot of in-person payments, you may fall for the trap that this is meant to protect you. As I mentioned earlier, debit typically is about 0.25%. And if you're charging 1%, then you are getting overcharged completely. And so understanding your type of transaction mix will determine if a tiered pricing structure is the right one for you, if a flat fee structure is the right one for you. There's interchange plus, so many others. And on another video, I'll take a deeper dive into each one of these processing types. But it's important to know that those three areas are the main culprits for most organizations to lose money. It's the fallacy that flat rate pricing protects you. It's the fact that small line items can get hidden on fee statements. And it's the third of transaction mixes can have a really meaningful impact on your bottom line, and understanding what your mixes are so that you don't get stuck in a long-term tiered contract. Really, really important. So with all of this information, it sounds like it would behoove someone to go ahead and do the work of finding out how their transactions are flowing, where they're going, and how much they're paying. But the reality is changing processors is difficult. And so the main reason why people don't act is it's the fear of switching costs. Switching costs can be high if you are with a processor who is really ingrained in your business. For instance, if you are working with an organization where you're working with a processor where they are responsible for your ACH, they're responsible for your credit card transactions, both in person and card not present. They're responsible for your payouts. They're responsible for your payment plans with your customers. Maybe you actually have tokenized payment methods, which means someone's card is saved on file. Well, what happens if you change processors? You got to chase all that down again? So what happens is most business owners choose not to act because they feel as though the cost of switching is so much greater than the headache of just simply paying the fees outright. This is 100% a fallacy and 100% something that shouldn't be a fear of business owners. And here at Paygent, we want to equip you with the knowledge of understanding how to actually make that change. Even though it sounds scary, it really isn't. And there's opportunities that you can do to lower your overall fees. The other reality is to reduce your fees. Sometimes you don't have to switch a single thing. You can stay with your existing processor. You can continue to optimize how your transactions are being processed. And so as you're making your own actions, it allows for your fees to go down. Great example is if you're at an organization where, let's say, the average transaction is more than $2,500. B2Bs, this is typical. If you are paying on credit card, my friend, you are missing out. Transactions more than $2,500, the cheapest and lowest cost way for us to transact those is through an automated clearinghouse, an ACH, or an EFT if you're in Canada. This is a bank-to-bank transfer, and with the bank-to-bank transfers, did you know they're actually capped? And so that's where I say if you're at a $2,500 threshold, and give or take on that number, but if you're within that general range, your fees can typically be capped at $10, maybe $20. And so now you know that that fee is significantly less than if it were to be at a flat rate being charged for a transaction on a credit card. And so these are all different reasons to truly understand how your payment processing works and where your levers are. The other thing that you can control and that helps you reduce your fees, possibly without even changing processors, is if you happen to be with a processor that offers you something like interchange plus or tiered pricing, you can actually start to encourage your consumers to use their card in a more meaningful way. So for instance, and I'll give a little bit of history here, when COVID began, prior to COVID, there was a strict rule that card not present transactions could only exceed a certain percentage of your card present. Because if you are literally keying in a transaction and keying in a credit card, that person's not there. Doesn't matter if they're standing in front of you. If you're keying in their number, the processor is going to assume that the person is not present. Well, during COVID, when we had contactless payments, it became the norm for people to put their credit card over the phone and then pick up curbside so we didn't have to interact. It became norm for different companies to use things like Uber Eats and Postmates and Instacart and all of these delivery services where you now pay for the food or pay for the groceries or errands online, not present, but you actually are handing it to an individual person. Well, if you're not familiar, card not present transactions tend to also have the highest fraud rates. And since they have the highest fraud rates, processors want to make sure they're covering their own risk. And so they do that by charging an additional fee. So anytime you have to take a card and the person has an option of typing it in or swiping it, if they choose to type it in, it is a higher fee to that merchant. Done, period, end of story. So you as a merchant have some opportunities to say, hey, Mr. Consumer, instead of you handing me your card, do you mind swiping right here? all of a sudden that completely changes the game and you are now in control of your own fees. So other ways that you can actually control this are things like getting a mobile reader for your phone. Now, typically, we've seen a lot of processors start to move to mobile devices just simply because business owners are so used to working on mobile devices. You're in the field, you need to go to a customer who's at the front of the sales floor. All of those reasons you may float around with a mobile device. You can get a mobile reader, which attaches to your phone, typically through the charging port, and it connects to allow for you to swipe. Most companies offer these for free, if not a very nominal value or nominal cost, because quite frankly, it helps them. If you're transacting at a lower fee, especially if you're on flat rate, they're the ones who get to benefit from you using that mobile reader. And so you're going to find that it's very often they will push these mobile readers, especially on flat rate processing, because you're paying for you're paying the device to get the fee down. So simple way to get your fees down. If you're on flat rate processing, well, thank you for your service. Other ways that you can do this, I've already talked about using ACH. If you are in person and you have the option of using a debit card, a PIN debit where they have to actually enter their PIN is much less in fees than a swipe debit that acts as a credit card. If it acts as a credit card, it's getting fees like a credit card. And that is always going to be higher versus the PIN debit that allows for the consumer to authenticate their account before they actually transact. So all of these different things, I hope you're understanding, is that these are little ways that without changing very much, you can make a meaningful impact on how you're driving down your own effective rate and bringing that much lower than the typical rates that we're seeing out there. All right, so I've said a lot about how merchants are possibly overpaying. The reality is when you take a look at this holistically, thereby from a telepay study that was conducted, that's where they determined on average, most merchants are overpaying $2,400 per year. And it's because they could make these micro changes that can have a positive impact. And I don't know about you, but $2,400 more in my pocket could certainly go a long way. So what do you do with this? You're empowered with this knowledge. You're ready to take action. What now? Well, the first thing and the most important thing that you can do is learn how to calculate your effective rate. If you don't take another tip of advice from this video, my hope is that you understand effective rate is the holy grail when it comes to payment processing. It normalizes how many fees you're being charged. It allows for you to see apples to apples, what is the effective rate and how much am I potentially overpaying. The other thing that you can do is you can start to look up where your top revenue leaks are occurring. Revenue leaks could be anything from are your cashiers typing in account numbers versus swiping, okay? Do you potentially have a sign to encourage consumers to type in their PIN over swiping their debit card? Simple as it is, it's a revenue leak and it's an opportunity. The other is, are you taking large transactions? And if so, are you taking it on credit card? If you are, consider switching over to ACH to lower your fees instantly. And then the last step is equipped with your effective rate, equipped with understanding what type of transactions you're taking. The third step is to look at different processors. You can look at processors based off of the type of processor they are, flat rate, you got tiered pricing, you got interchange plus, and get a comparison. You can provide them with a statement so they have an understanding. The other thing you can do is you can use Paygent. And this is exactly what we're here for. Our job is to help businesses understand their consumer transaction habits so that you can find the best processor for your unique business. We know payments is not a one size fits all. And even though will give you all of the knowledge in the world, we also understand that your job is to run your business. And our job is to help you be the payments expert, even if you don't have that expertise. And so using a system like Paygent to verify that you're getting the right rate, to verify that you have the right processors, and maybe be able to uncover different ways that you can lower your transaction fees without making many changes. If you don't use Paygent, we do recommend that you use some version of a statement analysis to help educate yourself as you go. So in summary, the way that you can close this loop and really take action at this time is a few things. Understand that different rates plus low visibility plus the fear of switching plus the fact that card not present is so prevalent and also so expensive. If you are recognizing and any one of those things felt like that may be me, then there is a very good chance that you're overpaying. And that's not something to be shameful about. In fact, that's something to take action against. And using this information to better your business will better you in the long run. If you want help spotting leaks, again, please visit Paygent.ai, and we would be more than happy to help be your trusted advisor for payment technology. Thank you so very much for listening to this. We look forward to sharing more videos.